Welcome to this in-depth presentation titled, Is YieldMax ETFs the future of high-yield investing? In the next 50 minutes, we will explore the structure, performance, opportunities, and risks associated with YieldMax exchange-traded funds and evaluate whether they can truly serve as a sustainable source of high income for long-term investors. My goal is to provide factual, well-structured information in a professional and educational tone so you can make informed decisions about your own investment strategies. Before we begin, please ensure you are comfortable and ready to engage with this detailed discussion. You may also want to take notes during the presentation to capture the key insights and data points we will cover. Let us begin by setting the stage with a clear understanding of the current investment environment. As of today, many investors are facing a persistent challenge, finding reliable income in a financial landscape characterized by rising volatility, uncertain interest rate trajectories, and a growing need to protect capital while still achieving attractive returns. Traditional dividend-paying equities, such as those included in well-known ETFs like the Schwab U.S. Dividend Equity ETF or the Vanguard High Dividend Yield ETF, continue to play a role in diversified portfolios. However, the yields offered by those strategies may not be sufficient for investors who depend on their portfolios for recurring income, particularly in retirement. In response to this need, a new set of investment products has emerged over the past few years. These are option-based income ETFs, designed to generate elevated cash flows through the systematic use of derivatives, in particular covered call strategies. Among these funds, YieldMax ETFs have quickly gained significant attention due to the very high distributions they provide, sometimes surpassing levels that many income-focused investors viewed as unattainable in public markets. To thoroughly evaluate the question of whether YieldMax ETFs represent the future of high-yield investing, we will proceed in a structured manner. First, we will clearly define what YieldMax ETFs are and how they differ from other option income products. Second, we will examine why these products have attracted substantial interest since their launch. Third, we will analyze their underlying strategies and evaluate how they generate yield. Fourth, we will look at specific examples of YieldMax ETFs and review their payout history, performance dynamics, and portfolio construction. Fifth, we will address the key risks and limitations associated with these products, including market risk, strategy-specific risks, and tax considerations. Finally, we will consider the long-term outlook and whether these ETFs are likely to form an integral part of the income-seeking investor's toolkit in the years ahead. Let us begin with a precise definition. A YieldMax ETF is a publicly traded fund listed on a major U.S. exchange that seeks to deliver high income by executing synthetic covered call strategies on a single underlying equity. Unlike traditional covered call ETFs, which purchase shares of the underlying stock and then sell call options against those shares, YieldMax ETFs use a combination of cash-settled options to replicate the exposure to the underlying while simultaneously selling call options to generate option premium. This structure allows the fund to avoid directly holding the stock, while still providing economic exposure that is similar to ownership. At this stage, it is important to note that the YieldMax family consists of two broad categories of ETFs. The first category focuses on individual companies. Examples include ULTI, which is tied to Tesla, NVDY, which is linked to NVIDIA, and APLY, which references Apple. The second category includes funds of funds, such as YieldMax and YieldMax, which hold portfolios of individual YieldMax ETFs in order to create diversified exposure to multiple underlying stocks. In both categories, the core objective is the same: to convert the price volatility of well-known growth companies into income through the disciplined sale of call options. Why has this approach resonated with investors? One reason is simple arithmetic. In recent years, many growth-oriented technology stocks have exhibited extremely high levels of implied volatility. In the options market, higher implied volatility translates directly into higher option premiums. By systematically harvesting these premiums, YieldMax ETFs have been able to generate distribution rates that are significantly higher than the yields available from traditional dividend strategies or investment-grade fixed income products. However, one must also recognize that these high distributions are not guaranteed and are not directly equivalent to the dividends paid by operating companies. Rather, they are the result of option premiums that are earned if market conditions remain within a certain range. As a result, understanding how the strategy behaves during different market environments is critical to evaluating its suitability for long-term investment purposes. In addition to the elevated income potential, another factor driving investor interest is the increasing availability and accessibility of these products. In the past, option-based income strategies were primarily available through separately managed accounts or hedge funds, often requiring high minimum investments and substantial fees. YieldMax ETFs, on the other hand, are exchange-traded products that can be purchased and sold like any other stock or ETF, with no minimum investment requirement other than the cost of one share. This democratization of access has broadened the appeal of the strategy and allowed a much larger segment of the investor population to participate in option-driven income generation. With these initial points established, let us now move into a more detailed analysis of how these ETFs operate. The fundamental building block of the strategy is the covered call. A covered call involves holding an asset and simultaneously selling a call option on that asset. The option premium received provides immediate income, but in exchange, the seller gives up the potential for unlimited upside if the price of the asset increases above the strike price of the option. To clarify further, when the price of the underlying asset rises above the strike price of the sold call option, any additional appreciation beyond that point is forfeited by the option seller. In return, the option seller receives the option premium as compensation. This is precisely the trade-off at the heart of covered call strategies. The investor gives up some portion of the upside potential in exchange for a predictable stream of income. YieldMax ETFs utilize this principle in a slightly different manner. Rather than purchasing the underlying stock directly, they use total return swaps or other derivative instruments to synthetically replicate exposure. Then, they sell call options on that synthetic exposure. The reason this approach can be advantageous is that it allows the fund to limit the need for large capital outlays while remaining fully invested in an income-generating strategy. To put this into perspective, let us consider a simplified hypothetical. Imagine an investor wants to gain exposure to a particular stock trading at $100 per share. In a conventional covered call strategy, the investor would purchase the share at $100 and sell a call option at, for example, a $105 strike price. If the option premium is $3, the investor earns $3 in income, or 3% relative to the cost of the stock. If the stock later rises to $110, the investor's upside is capped at $105, plus the $3 premium, for a total of $108. In other words, the maximum gain is limited, but the income is locked in at the onset of the contract. YieldMax ETFs use synthetic exposure to execute essentially the same trade, except through derivatives rather than direct equity purchase. Having established the mechanics, let us now examine the performance of some of the flagship YieldMax ETFs in more detail, beginning with ULTI, the YieldMax TSLA Option Income Strategy ETF. ULTI aims to provide exposure to Tesla through derivatives while selling call options to generate premium income. Since Tesla is a highly volatile stock, the option premiums available on it tend to be substantial. As a result, ULTI has delivered distribution yields that, on an annualized basis, often exceed 60%, although this figure can fluctuate based on option pricing conditions in the market. We will now review several distribution examples that illustrate how the strategy functions. In one particular month, the fund distributed approximately $1.45 per share. If we annualize this level of distribution based on the fund's average share price during the same period, it suggests an annualized yield in excess of 70%. While this level of income may appear extremely attractive, it also reflects a trade-off. In periods when Tesla's share price experiences strong appreciation, ULTI is likely to underperform the underlying stock because the upside is limited due to the sold call options. Next, let us turn to NVDY, the YieldMax NVIDIA Option Income Strategy ETF. Like ULTI, NVDY generates premium income from selling call options. However, it references NVIDIA, a company that has experienced exceptionally high levels of implied volatility in recent years. This heightened volatility translates into larger option premiums, which explains why NVDY has, at times, delivered even higher distribution yields than ULTI. For example, in one recent period, NVDY distributed more than $2.10 per share in a single month, which, when annualized, corresponds to a yield of more than 85%. It is important to emphasize again that these yields are not guaranteed and are subject to change, reflecting the prevailing volatility environment. In contrast to ULTI and NVDY, which focus on individual companies, the YieldMax ETF seeks to provide diversified exposure to multiple option income strategies. Instead of referencing one underlying stock, it allocates its assets across several YieldMax single stock ETFs. Through this structure, YieldMax aims to smooth the income profile and mitigate the concentration risk associated with relying on a single company. For investors who prefer diversified income exposure, YieldMax may be more attractive than individual single-stock YieldMax ETFs, although the resulting yield is generally lower due to the more diversified approach. In the next section of this presentation, we will take a deeper look at precisely how these fund of funds products are constructed and how their income distributions compare to those of the individual underlying funds. In particular, we will examine the YieldMax Magnificent 7 Fund, known as YMAG, which aggregates option income strategies linked to 7 major technology companies. We will also assess the consistency of the distributions over time, as consistency is a crucial factor for income-oriented investors. To begin that review, let us consider the composition of YMAG. This fund includes synthetic covered call exposures to companies such as Apple, Microsoft, Amazon, NVIDIA, Meta Platforms, Tesla, and Alphabet. Each of these companies is well known for its leadership in the technology sector and for its historically elevated level of share price volatility. By aggregating covered call strategies across all 7 of these companies, YMAG seeks to capture a diversified option premium stream. In practical terms, this means that, even if volatility decreases for one company, it may remain elevated for another, thereby supporting overall income generation for the fund. The data supports this concept. In its early distribution history, YMAG demonstrated relatively stable payouts on a monthly basis, although the actual amounts fluctuated in response to changes in volatility across the underlying constituents. While the aggregate yield of YMAG has tended to be lower than that of the highest-yielding individual YieldMax ETFs, it has still been significantly higher than the yields available from traditional dividend-focused ETFs. This indicates that diversification does not necessarily require investors to forego an attractive income stream, provided the underlying strategy remains option-based and is implemented in a disciplined manner. Now that we have reviewed some of the flagship YieldMax ETFs and fund of funds structures, it is essential to discuss how these funds generate their distributions on a recurring basis. As mentioned earlier, the core driver of income is the sale of call options. These options are generally short-term contracts, often expiring on a weekly or monthly basis. The fund continuously sells new options as previous contracts expire, thereby creating a consistent stream of premium income. This systematic approach allows YieldMax ETFs to make frequent distributions, sometimes on a weekly schedule, which distinguishes them from traditional dividend-paying ETFs that typically pay quarterly or monthly. To understand the mechanics in greater detail, consider the life cycle of a single option contract within a YieldMax ETF. The fund writes a call option with a strike price above the current market price of the underlying synthetic exposure. This strike price is carefully selected based on market conditions, volatility expectations, and the desired balance between income generation and participation in potential upside. If the underlying price remains below the strike price at expiration, the option expires worthless and the fund retains the full premium as income. If the price exceeds the strike price, the fund may be required to settle the option in cash, limiting its gains from the underlying movement, but still retaining the premium received initially. One of the most important points for investors to volatility is a measure of how much the price of an asset fluctuates over time. Higher volatility leads to higher option premiums because the likelihood of significant price movement increases. Conversely, when volatility is low, option premiums are smaller, and income generation may decrease. For YieldMax ETFs, this means that periods of high market volatility are generally favorable for income, while prolonged periods of low volatility may result in reduced distributions. Understanding this relationship is critical for evaluating both the potential and the limitations of these products. In addition to volatility considerations, the underlying price trend of the synthetic exposure also affects fund performance. In a strong bull market, where the underlying assets experience rapid price appreciation, the upside is capped due to the sold call options. Consequently, investors may experience underperformance relative to holding the underlying asset outright. On the other hand, in sideways or moderately rising markets, the combination of stable asset prices and ongoing option premium sales often results in highly attractive total returns. This dynamic illustrates the fundamental trade-off inherent in option income strategies: high income in exchange for limited participation in extraordinary price appreciation. Having explored the mechanics and the income dynamics, we will now examine historical performance examples of selected YieldMax ETFs to provide context. While past performance is not indicative of future results, analyzing historical data helps illustrate the range of outcomes that investors may expect under different market conditions. Consider, for instance, ULTI over a 12-month period. During a period of moderate Tesla price fluctuation, ULTI generated distributions that produced an annualized yield exceeding 65%. Meanwhile, the underlying Tesla stock appreciated by approximately 30% over the same period. The capped upside for ULTI reflects the impact of the call options, yet the investor still benefited from a substantial income stream. NVDY, tracking NVIDIA, demonstrates similar patterns. In months with high implied volatility, the ETF produced substantial premiums and attractive yields. Conversely, during periods of low volatility, distributions declined slightly, although they remained higher than yields from traditional dividend ETFs. Importantly, these fluctuations are expected and form part of the risk-reward profile inherent in option-based strategies. This highlights why a professional investor approach, with careful attention to portfolio allocation and risk management, is essential when considering YieldMax ETFs for high-yield income. Moving beyond individual ETFs, let us consider fund-of-funds products such as YieldMax and YieldMax. These funds aim to stabilize income generation by diversifying across multiple underlying YieldMax strategies. Historical data indicates that while individual single-stock YieldMax ETFs can experience significant monthly variation in distributions, the aggregated approach of the fund-of-funds tends to smooth this volatility. For example, YieldMax's monthly payouts generally fluctuate within a narrower band, providing more predictable cash flow for income-focused investors. This demonstrates the value of diversification even within a high-yield option income strategy. Another important consideration when evaluating YieldMax ETFs is tax treatment. Distributions from these funds are generally classified as ordinary income rather than qualified dividends. This distinction can affect after-tax returns for investors, particularly those in higher tax brackets. Understanding the tax implications of YieldMax distributions is critical for determining net income potential and for planning purposes. Investors should consult with qualified tax advisors to evaluate the impact of these distributions within their broader financial plan. At this point, it is also worthwhile to address liquidity and trading considerations. As exchange-traded funds, YieldMax products can be bought and sold during regular market hours, providing flexibility and transparency for investors. However, the liquidity of certain single-stock ETFs can vary depending on market conditions and investor interest. Bid-ask spreads may widen during periods of market stress, which can affect execution prices. Awareness of these practical considerations is essential for managing trading costs and maintaining an efficient investment strategy. With the mechanics, income dynamics, historical performance, tax treatment, and liquidity considerations discussed, we are now well prepared to analyze the suitability of YieldMax ETFs for different investor profiles. These products tend to be most appropriate for investors seeking regular income, willing to accept limited upside potential, and comfortable with the inherent risks of option-based strategies. For retirees or those relying on portfolio-generated income, YieldMax ETFs may offer an attractive supplement to more traditional income sources, provided that allocations are carefully managed and diversified. In conclusion for this section, the combination of synthetic exposure, systematic option writing, and frequent distributions positions YieldMax ETFs as a potentially transformative tool for high-yield investors. However, as with any investment strategy, understanding the trade-offs, limitations, and risks is critical before. The next part of our presentation will explore a deeper comparative analysis between YieldMax ETFs and traditional high-dividend ETFs, evaluating total returns, risk-adjusted performance, and scenario-based outcomes to provide a comprehensive perspective for professional investors. As we move into a comparative analysis, it is essential to establish benchmarks. Traditional dividend ETFs such as the Schwab U.S. Dividend Equity ETF, SCHD, or the Vanguard High Dividend Yield ETF, VYM, typically offer annual yields in the range of 2.5 to 4%. In contrast, YieldMax ETFs, as we have discussed, have delivered annualized distributions often exceeding 50% during favorable market conditions. However, the comparison requires nuance, as the sources and consistency of income differ fundamentally. Let us first consider the risk-adjusted perspective. Traditional dividend ETFs offer steady income primarily derived from underlying company profits. The capital appreciation component is subject to stock market performance, but the yield itself tends to be more stable and predictable. YieldMax ETFs, on the other hand, derive income from the sale of options, which fluctuates based on market volatility and the performance of the underlying stock. Conditions. To illustrate, consider a scenario in which the market experiences a prolonged rally in technology stocks. Traditional dividend ETFs may experience moderate capital gains in addition to consistent dividends. YieldMax ETFs, while continuing to earn premiums from call sales, may underperform the underlying equities in terms of total return due to the caps imposed by the sold options. Conversely, in a sideways or moderately declining market, YieldMax ETFs may outperform traditional ETFs on a total return basis, as the income from option premiums can offset any small declines in the underlying price. Next, we examine the frequency of distributions. Many income-focused investors value predictability and regular cash flow. Traditional dividend ETFs typically distribute income quarterly or monthly. YieldMax ETFs, by contrast, frequently distribute on a weekly or monthly schedule. More regular compounding of reinvested income. Another important dimension is portfolio allocation. For investors seeking a balanced approach, YieldMax ETFs can serve as a complement rather than a replacement for traditional dividend strategies. For example, an investor could allocate 60% of a portfolio to traditional dividend ETFs to provide stability and modest growth, and 30 to 40% to YieldMax ETFs to increase income potential. Cash or fixed income holdings could occupy the remaining allocation, providing additional liquidity and risk mitigation. When analyzing long-term total return, it is important to consider both distributions and capital gains or losses. Historical data shows that in periods of moderate volatility, YieldMax ETFs can deliver competitive total returns compared to traditional high-dividend ETFs, with the added benefit of elevated income. However, in strong bull markets, the capped upside from options may reduce relative total returns. Professional investors often examine scenario analyses and stress testing to understand the performance range under different market conditions before allocating significant capital to these products. Tax considerations, as previously mentioned, are also critical in the comparative analysis. Traditional dividend ETFs may offer qualified dividends taxed at lower rates, whereas distributions from YieldMax ETFs are generally taxed as ordinary income. This difference may influence the net after-tax yield, particularly for investors in higher tax brackets. Effective tax planning and portfolio structuring can mitigate some of these effects, but investors must be aware of the implications. Beyond the numbers, another consideration is the psychological impact on investors. Receiving frequent, high-yield distributions can provide a sense of stability and immediate gratification, which may reduce the temptation to make impulsive portfolio changes during periods of market volatility. Conversely, the potential underperformance relative to the underlying stocks in strong bull markets may create frustration if investors do not fully understand the trade-offs of the strategy. Education and awareness are therefore paramount. A practical example of portfolio integration might involve a retiree seeking $5,000 per month in income. Traditional dividend ETFs could provide $2,000 per month in stable income, while YieldMax ETFs could supplement $2,500 to $3,000 per month, depending on market conditions. Cash reserves or fixed income could supply the remaining amount. This approach balances income generation with risk management and allows the investor to benefit from the higher yields of YieldMax ETFs without concentrating risk in a single strategy. In terms of long-term outlook, it is also important to consider industry trends. The growing popularity of option-based ETFs suggests that more issuers may enter this space, potentially offering additional strategies and diversification options. Institutional interest is gradually increasing, which could enhance liquidity, efficiency, and market transparency. These trends indicate that option income ETFs, including YieldMax products, may form an increasingly significant component of income-oriented portfolios in the years to come. Finally, we examine the concept of risk-adjusted yield. It is not sufficient to focus solely on absolute distributions. Their portfolio to these products. First, let us discuss market risk. As with any equity-related investment, the value of the underlying exposure can decline. While the sale of call options provides some cushion through premiums, it does not eliminate the risk of loss if the underlying stock experiences a significant downward move. Investors should consider how such declines could impact both the capital value of their holdings and the stability of future income distributions. Second, there is strategy-specific risk. As mentioned previously, distributions from YieldMax ETFs are generally taxed as ordinary income. Changes in tax policy or interpretation by regulatory authorities could impact the net income received by investors. Additionally, while the funds currently operate under U.S. SEC regulations governing ETFs, regulatory changes affecting derivatives, swaps, or option strategies could potentially influence fund operations, liquidity, or returns. Sixth, performance variability. While historical yields have been high, it is important to understand that YieldMax ETFs are not guaranteed to maintain elevated distributions in every market environment. Prolonged periods of low volatility, sharp downward trends in the underlying stocks, or adverse macroeconomic conditions could result in lower than expected income. Having outlined the key risks, we will now discuss how investors can mitigate them. Diversification is critical. Allocating across multiple YieldMax ETFs, combining single stock and fund of funds products, and maintaining a core of traditional dividend or broad market ETFs can help manage risk while preserving income potential. Rebalancing periodically to ensure that no single strategy dominates the portfolio is also recommended. Another important mitigation tool is position sizing. Professional investors often limit exposure to high-risk, high-income strategies to a defined portion of their overall portfolio. This approach allows them to capture elevated income without over-concentrating on any one strategy or underlying stock. In addition, understanding market conditions and volatility cycles is essential. By monitoring implied volatility levels, interest rate trends, and broader market sentiment, investors can better anticipate potential changes in option premiums and adjust allocations accordingly. While YieldMax ETFs are designed to operate systematically, informed oversight can help maximize long-term income outcomes. Risk monitoring should also include scenario analysis. Thank you for joining this in-depth exploration of YieldMax ETFs and their role in the future of high-yield investing. By understanding the mechanics, evaluating historical performance, acknowledging the risks, and considering future trends, you now have the knowledge to make informed decisions about incorporating these innovative ETFs into your investment strategy. If you found this discussion valuable, consider subscribing to our channel, liking this video, and sharing it with other investors who may benefit from understanding high-yield option income strategies. Additionally, leave a comment below with your thoughts, experiences, or questions about YieldMax ETFs. Your engagement helps create a community of informed, professional investors focused on maximizing income while managing risk. Once again, thank you for watching. We hope this comprehensive 50-minute presentation has provided clarity, insight, and actionable understanding regarding YieldMax ETFs and their place in the evolving landscape of high-yield investing.